In this session, we will focus on credit risk and the credit derivatives, wherein initially we will try to understand what is the credit risk, and probably try using the Merton model, understand how the credit risk is computed. Then we would also look out for the credit spread, right? How do I typically get into the computation of the credit spread? What is the kind of relationship that the credit spread carries with the maturity period, which is the time to maturity, and what kind of relationship the credit spread carries with respect to the interest rates? That's one more dimension that we will look at. How to determine the value of the firm value and volatility. What are the various mechanisms to determine the value of the firm as well as the volatility? And looking at the subordinated debt, right, especially not a senior debt. How do I get into the valuation of the subordinated debt? How do I look at the valuation mechanisms relating to that? And how do I use the various interest rate specific models for accomplishing that aspect, interest rate specific models? Then how do I compute the probability of default and the loss given default using let's say the Merton model or any other models? Then looking at the credit risk portfolio based models, we'll talk about a few credit risk portfolio based models like getting into credit metrics and KMV kind of models. We'll get back to them, or probably credit risk plus also. So, what are the key things associated with these models? That's one thing that we will try to look at. And finally, we would also try to focus on the credit risk of the various derivative instruments involved. So we'll specifically look out for credit derivatives, where we look into the hedging of our credit risk using the various derivatives, and trying to look out for instruments like credit default swaps and total return swaps kind of instruments. And so how do I typically mitigate my positions using the derivatives? And we are also talking about a vulnerable kind of options. We'll talk about these kind of things towards the last. Vulnerable options, which are more like derivatives with the credit risk involved. So we will look at all those things, and finally uh, in valuing a swap and these kind of derivatives, how do I incorporate the credit risk exposure? All these things we will try to cover as a part of this session, right? So we'll start off with the Merton model and then start moving forward. All right. Now, if I have to understand the world of credit risk, it is purely associated with the inability and the willingness to pay. Probably we are talking about a contractual obligation, and one party obligated to pay to the other party, but defaulting on the same, not adhering to the contractual obligation and defaulting on the same is what we are referring to as the credit risk. Now, the assessment of that credit risk, the value of that credit risk is very much important as a part of the risk management process, because one based on what is its value, the risk manager would be thinking of how to mitigate it. So as we have discussed earlier, whenever we talk about the credit risk, one is with respect to loan or debt, inability to pay the interest or the principal as per the contractual obligations. That is what is the default that is associated with the debt and the loan payments. And the second major aspect that comes is a counterparty risk, which could be involved with respect to derivatives transactions, where the value is positive but the other party failing to make the payment, resulting in the loss for the current party. That is what is getting classified as the counterparty risk. So basically I could also look out for any kind of contracts where we are trying to work out on the derivatives. By using the derivatives to mitigate the risk, credit risk, we are calling them as credit derivatives. Today one of the more popular instruments in the market. So we have to look out for these kind of instruments also. Now getting into the value, computing the value of this credit risk, we have seen that a Merton based model is one of the more prominent things to evaluate the credit risk. Now, as we have discussed earlier in many occasions also, it uses the concept of the Black-Scholes model, the formula of Black-Scholes model, the assumptions of the Black-Scholes model to typically evaluate the value of the to evaluate the credit risk, to provide some information regarding the credit risk, which could be in terms of computing the probability of default, etc. But as we have already looked at it, the major assumptions or the simplest form associated with this model is we are assuming that the debt is a single zero coupon bond with a maturity equal to the average maturity period of the entire set of securities. That is one assumption that we have made. We have also made that the markets are perfect. The financial markets are perfect, means no taxes, no transaction costs, or even no bankruptcy costs. So no other costs that are involved with the same. And we are talking about a non-dividend paying stock. Non-dividend paying firm. And on the top of all these things, we have also said that at any point in time, if the value of the firm is less than the value of the debt, we said that the firm is going to default, and the difference between the two is what is the loss that is absorbed by the debt investors. But at the same time, if the value of the firm is greater than the value of the debt, the difference is what is the value that would be paid to the equity investors. This is what is the basic workout we have done. So in this case, the equity investor will receive nothing, and the debt investor will receive a cut in their value. Whereas in this case, the debt investor will receive everything, the whole principal, whereas the equity investor will receive the balance, and which is exactly similar to that of a call option. This payout is what is exactly similar to that of a call option. If I join these two, it is coming out as either the maximum of the value of the firm minus the value of the debt, or zero. The maximum of these two is what the equity investor is going to receive in case of this. So based on this, I could relate that the value of the equity, right, probably using the concept of options, I could say that the value of the equity is same as call option on a firm whose strike price is equal to the value of the debt. And we have made an assumption that the debt is nothing but a single zero coupon bond with the total amount equal to the value of the total liabilities, which is maturing at time t. So the value of the equity is getting expressed like this, which means if as long as the value of the firm is less than the strike price, which is the value of the debt, the equity holder is going to get nothing. But if the value of the firm increases more than the value of the debt, the difference is the payoff that the equity investor is going to get. So the same logic we have extended even for the value of the debt, right? So I could have simply considered value of the debt as a risk-free investment along with a short put option on the firm with the strike price equal to the value of the debt itself. So here we will try to get the value of the debt as nothing but the total value, the risk-free rate of return. Basically, it's a risk-free investment. So whatever the D that we are going to get minus the maximum of the value of the debt minus the value of the firm, comma 0. So because this is a short put option, the short will start gaining. See, he has received a kind of a premium, and he will start gaining if the stock price goes up, right? A long put starts gaining if the stock price goes down, and a short put starts gaining when the stock price goes up. Otherwise, his loss is to the extent of D minus of whatever is the debt value minus this. So we could very well express our value of debt as well as value of equity in the form of an option, both in the form of an option, a call option for the value of the equity and a put option for the value of the debt. Now we also know that the value of the whole firm is nothing but the value of the debt plus value of equity. So from here I can very well derive that the value of the debt is nothing but the value of the firm minus the value of the equity and so on. Now the equity is nothing but the maximum of the stock price. The stock price is value of the firm minus the value of the debt at a particular point in time as well as 0. So you can very well try writing the multiple mechanisms of finding out the value of the debt. Now the point is the same Black-Scholes formula. Some of the assumptions that are associated with it, the sigma is constant. So if I assume sigma is constant for a Black-Scholes formula and R is constant, probably the Black-Scholes formula can very well be applied for any kind of a time period. So if at all I want to find out the value of the debt, so not looking at the value at a point at the maturity date, but if I want to find out the value somewhere before the maturity also, we are trying to use the same relationships using I can find out the value of the equity and the value of the debt using the simpler arbitrage pricing kind of a relationships. Now if we see in the regular case, we were talking about the value of the firm, value of a option is nothing but the spot price multiplied by n of d1 minus the present value of the strike price multiplied by n of d2. And we also said d1 is nothing but log s divided by x plus r plus sigma squared by 2 into t divided by sigma root t, and d2 is coming out as d1 minus sigma root t. This is what we have written. Now the same logic, let's see. Let's try to apply the value of the equity not as of today, but let's say at some point in time in between. So the value of the firm. So at that point, whatever is the value of the firm, I can get the value of the firm. Okay, and d1, that part is still the same, minus the present value of the strike price. The strike price is nothing but the maturity value of the debt. So the present value, if I have to find out, it is e power minus r into t minus t. T is the maturity period, but I am trying to value it sometime before the maturity period itself. So I am trying to find out the present value of the debt multiplied by n d2. Now d1, how do I write it? Log s will still remain the same, value of the firm, but strike price always I should be writing it like this, which is the present value of the debt. So I'll write it as this one, log s by x plus, this is where, see, when I am talking about the r, as of today, if I am trying to find out, then r comes into picture, which is the risk-free rate of return. But if I am trying to look at a future date, the r does not play any role. So directly I will take sigma squared by 2 into t becomes t minus t divided by sigma root t minus t. Now probably this is what is working out as the value of d1, and d2 will go as d1 minus of sigma root t minus t. So this is what will go as a part of my d2 for the computation purposes. So from here I could be able to find out the value of equity, and also I can find out the value of the debt also. Probably it's easier to take one numerical example to try solving this kind of a situation. So let's try to take the value of the, so my intention is to find out value of the equity as well as debt. I want to find out these two things. So at this point I am seeing that the value of the fund, value of the firm, let's say is $100 million. Value of the firm is 100 million, and probably the debt, the face value of the debt, I am assuming it as 75 million, probably after 5 years. Probably the maturity period of the debt is 5 years and the face value of the debt is 75 million. And I'm also looking at a constant interest rate during this entire period, let's say 6% constant interest rate, and the volatility of the firm during this period, let me assume that it is around 15%. Now based on this, if I want to find out the value of the equity as well as the value of the debt, I should be able to find it out at a point in time t. So at this current point, where 5 more years is there for the maturity, I can look out for the value of the equity is value of the firm multiplied by ND1 minus 75 e power minus R 6% into 5 into ND2. So all that I need is find out ND1 and ND2. So for that I require my D1 saying log the value of the firm 100 divided by 75 into e power minus 6% into 5 e power minus RT plus sigma squared 15% squared by 2 into t minus t, which is 5 periods, divided by sigma root t 15% into square root of 5. So this is what will work out to D1. So let me try to put this into a spreadsheet. Okay, so I can compute the D1 here as log value of the firm 100 divided by 75 times e power minus 6% into 5. This is the log part of it, plus 15% squared sigma squared by 2 into t, which is 5. Sigma squared by 2 into t. This entire thing I am trying to take it divided by the sigma root t. Sigma is coming out to 15% into square root of t. Working out to this being my D1, and D2 will work out as D1 minus sigma root t. This is the value of D2. So from here I should be able to find out ND1, which I'll take from the standard normal distribution value. I'm taking ND1, so which is around 96.74%, and the ND2 is working out to around 93.4. So from here I should be able to get the value of equity, which is nothing but the current firm value multiplied by ND1 minus the present value of the debt, 75 e power minus 6% into 5. So this has to be multiplied by ND2. So this is the value of the equity. So the value of the equity here is working out to 44.82 million. Right? The value of the equity is working out to 44.82 million. So probably just going with the concept, the value of the debt at a point in time should actually come out as 100 minus of the value of equity. So the value of the debt should come out to 55.17 million. But on the other side, I should be able to compute the value of the debt, one, through this process, or two, I could have taken the value of the debt as the current value of the debt I could have taken as debt on the maturity period, the face value of debt, right? I could take the present value of the face value, which is 75 e power minus 6% into 5. This is the present value of the debt. Along with that, I am also talking about a European put option, short put option on the same. So I could subtract the price of the put option. And the price of the put option I can very well compute based on the call put parity relationship. So let me just see what is the first term, 75 into e power. So the PV of debt is coming out to 75 into e power minus 6% into 5. So the present value of the debt is coming out to 55.56, and now I need to find out the value of the put option. When I am looking at the value of the put option, I can go with call put parity relationship, which talks about the difference between the call option minus put option is the spot price minus the present value of the strike price. Right? So I can use that particular relationship saying put option is nothing but call option plus the present value of the strike price minus the spot price. So using that same logic, I could have taken the value of the put as, okay, the value of the call plus the present value of the strike. So this is the present value of the strike minus the value of the spot. So put option is coming out to somewhere close to 0.39. So from here also I could compute the value of the debt as nothing but the present value of the debt minus the put option value, which is again coming out to 55.17. So either I determine through this mechanism, or wherein I look out for value of the firm minus the value of the equity to arrive at the value of the debt, or I look out for value of the debt is nothing but the present value of the entire obligation that has to be paid at a time period T plus a short put option on the firm whose strike price is equal to the value of the debt. So using either of the mechanisms, I should be able to compute the value of the debt. Now, few things which will help us in trying out finding the whether the value of the debt will increase or decrease. So because value of equity is more like a call option, long call option. So wherever the call option is going to increase, whatever are the factors that could contribute to the increase of the call option value will contribute to the increase of the equity value also. Right? We know that as R is increasing, call option value will increase, means equity value also increase. As the sigma increases, call option increases, means equity value also increases. Or as the time to maturity increases, the call option also increases, means equity value also increases. And probably as the strike price increases, right, as the strike price is increasing, the value, the call option value will decrease, so the equity value also will decrease. And because the total value of the firm is constant, the value of the debt will behave opposite to that of value of equity. The value of the debt will, but if the overall value of the firm itself is increasing, obviously both the value of equity as well as the value of the debt will increase. But keeping the value of the debt constant, all I can evaluate is what factors generally increase the value of a call option And based on those factors, even I would try to associate the value of the equity also will go up. And if the value of the equity is going up, obviously the value of the debt will come down because of the relation value of the debt is value of the firm minus the value of the equity itself, right? So this is how we can use the Merton model. A good understanding of the Merton model could help me in terms of valuing the equity and debt associated with the portfolios or with any investment, with any security. The right. So now in the next stage, I would try to introduce a newer concept which is more associated with the credit spread and the kind of relationship it is carrying with respect to the maturity duration and also with respect to interest rates. We'll take up a few examples to understand how this credit spreads link to maturity as well as to the interest rates. All right. So a simple way to look at the credit spread is nothing but whatever is the yield on a corporate bond minus the yield on a government bond or a treasury bond, risk free kind of a bond with the same maturity period. That is what we are calling as the credit spread. The yield on a risky instrument minus the yield on a risk free instrument of the same maturity. Because this extra yield is basically because of the high risk that is being taken to invest in that particular risky security. So the simple way we try to express, especially when it is not an annual kind of a period. If it is annual, probably I can take it. If it is on a yearly basis, yearly maturity, I could have taken this as straightforward as this. But otherwise, the generalized form I am looking at is the logarithm of, on a continuously compounded basis, if I have to look at it, logarithm of the current value of the debt divided by the face value of the debt. But this is over a t period, t year period. So that's where I am dividing it by t or t minus t for whatever is the time period we are looking at. This is coming out as our annual continuously compounded annualized kind of a credit spread. I take the negative of this and I subtract the risk-free rate of return from this, which will work out to be the calculation of my credit spread. So all we are saying is this particular relationship, as the time to maturity increases, right, as the time to maturity increases, we see that this number, now you try computing it, time to maturity is increasing means this number is increasing. So overall this number will come down. This number coming down, and because it's a negative of it, this number will go up. And the credit spread is actually increasing. Just using the formula, as the maturity period is increasing, the credit spread is increasing because there is a high possibility that you will lose your money. The value whatever we are receiving is less than the par value. So what we see is generally the credit spread will increase for any kind of a security. But generally in reality it is also observed that as the time to maturity has increased, especially for risky bonds, as the time to maturity has increased, it has been seen that the credit spread actually is narrowing down. Though from this equation it is seen that the credit spread has to increase with the increase in the maturity period, But for the risky bonds, it has been appearing that the credit spread is narrowing. The reason being, from a logical standpoint, if we see, if a risky security has not defaulted, let's say the maturity period is 10 years, because it's a risky bond, probably the default should have happened in the second year, third year, fifth year itself. If it not happened until, let's say, 8th or ninth years, continuously there has been a payment that has been done. There is a significant proportion of the payment that has been done till date, at that too at a higher rates of interest. So the chances of default in the ninth and the 10th years, in the last years, that's going to be much lesser. The chance of the payment being received in those later years is going to be much higher itself. If at all the default occurs, it should have occurred much earlier itself. So that is one thing that is a good observation that has come out. Normally, when I go with a general formula, I see that as the time to maturity increases, the credit spreads have to widen. But in reality, what has been observed, especially with the risky bonds, is towards the closing towards the maturity period, it is observed that the credit spreads are actually narrowing. That is one dimension. The second side is with respect to interest rates. If the risk-free rate of return is increasing, straightforward, value of the firm is going to increase. So value of the firm is increasing means probability of default is going to come down. So if the interest rates are increasing, obviously the value of the firm is going to increase. The value of firm is increasing means the probability of default is decreasing. So the credit spread will become narrow. So we have to understand the relationship between the credit spread. How is it linked with your maturity? How is it linked with the interest rates also? Right? Now, in the same, the other thing that I am looking at is, okay, I am valuing the equity using the Merton model. And even there we have made an assumption that there is only one single debt instrument and equity, which is the common equity. But in case, let's say we have a senior as well as subordinate debt, how do I find out the value for the same? Because as far as the settlement is concerned, initially the senior debt would be settled, and whatever is the remaining, the subordinate would be settled, and after that whatever is remaining, the equity investors would be settled. So probably it looks like the subordinate is not fully with the senior, or it's not fully with the equity also. So only after all obligations are paid to the senior debt, then only the subordinated debt will receive the payment. So probably it may so happen that even if the value of the firm is less than the value of the debt, it may so happen that the senior debt will still receive full, but the subordinate debt will receive a cut. So the subordinated debt, especially when I am looking at only these two forms, it is as good as I am valuing subordinated debt as an equity. Right? Probably if I have debt and equity, I am valuing equity as a call option on the whole firm, where the strike price is equal to the value of the entire debt. Now if I am looking at this mechanism of only this, then I am taking the value of the subordinated debt as a call option on the firm with a strike price equal to value of senior debt. If I take the value of the senior debt, so if the value of the firm is greater than the value of the senior debt, so here if we understand the logic, okay, value of the firm less than the value of the senior debt, then these guys are going to get 0. Value of the firm greater than the value of the senior debt, then the subordinate debt is going to get value of the firm minus the value of the debt of the senior debt, but to the extent of only value of the subordinated debt. So maximum of this or value of the subordinated debt, only this much is going to come up. So it's not a pure equity also, right? It's either the difference between the two or to a maximum extent of the value of a subordinated debt itself. So when I am trying to value an equity, probably I am looking at the strike price, which is the value of the senior debt as well as the subordinated debt. But when I am looking at the subordinated debt, I am looking at it as a call option on the firm with an exercise price, with a strike price equal to the value of that senior debt. But along with that, I am also taking a short call on the firm where the strike price is equal to the total debt. Why is that I am taking that? See, in case of call option, right, when as the price is increasing, the value is becoming negative. I mean, the long will gain and the short will lose as the value of the firm increases. Now, what I am simply saying is, as the value of the firm is increasing, this people, so I'll take plus short call means it's actually a kind of a minus the value of the call option. So plus short call or minus the value of the call. So as it is increasing, as the value of the firm is increasing, I want to look out for subtracting from whatever the value of the firm. I want to take out the value of the total debt. Either the maximum of that is what is coming out, right? Because see, if I'm looking at the regular scenario, I am getting the value of the firm minus the value of the senior debt. That is what should come out to the maximum of value of the subordinated debt. It's as good as saying I have taken a call option, I am long call on the subordinated debt or on the senior with the face value same as the senior debt. So as long as the value of the firm is greater than the value of the senior debt, the difference should go to the subordinated debt. But if the value of the firm is less than the senior debt, it should be 0. But this entire amount cannot go to the subordinated debt, but because there is a portion that is going to the equity investors. So that is where we are saying you subtract the call on you subtract the value of the call option on the firm where the strike price is equal to the overall debt, because that is the portion that will actually go to the equity investors. So the difference between these two is what is going towards the subordinated debt. So what we can very well do is the subordinated debt can very well be represented as an equity, right, where the call option on the stock can be taken. A long and short positions on the call are taken. Long and short positions on the call are taken. The long is taken with one strike price which is equal to the value of the senior debt, and a short call position is taken with another strike price which is on the basis of the total debt, which includes the subordinate as well as the senior debt. So that is how we are trying to value the subordinated debt. using the same Merton kind of a model, right? And one more thing that we are trying to look at in this context. See, if the interest rates, looking at the interest rates, if the interest rate is increasing, straightforward, as the interest rates have increased, the value of the debt will decrease, right? The value of the debt is increased, which means, and even we would see that the value of the equity also should decrease in a regular scenario. So whenever the interest rate is increasing, the overall value of the firm and all are falling. So we need to have some kind of mechanisms to understand how the value of the firm or how the credit risk can arise with the changes in the interest rates. Because on one side we have seen that if the interest rate is increasing, the credit spread will the credit spread should normally narrow down, right? So now for me the most important aspect is how do I use let's say the Merton model to compute the probability of default as well as loss given default. What is that I will do to compute, or what kind of things I gathered from the Merton model to compute this probability of default as well as the loss given default, and based on this I can proceed further to the various other models also and try to compare the various models that are arising in this situation, right? Using the Merton model, if I have to compute the probability of default and the loss given default, a few basic assumptions that I am making is the probability of default not correlated with the recovery rate, with the loss given default. In a normal base assumption, we said a model will become more and more complicated because as the probability of default increases, I am seeing that the loss given default also will increase. So, and vice versa. So, because of that, the modeling becomes more and more complicated. So, that is where I am making a plain basic assumption that the probability of default in general is not correlated with the loss given default, and that the recovery rate at any point in time is a fixed proportion of the lending value of the loan value in case the default occurs. So that is one major assumption that has been made. So which can help us in finding out the probability of default, and even going ahead with the loss given default, which can and even computation of the loss given default also. So where I am going with a simple Merton model to compute the probability of default, all I am looking at is the value of n of minus d2. Whatever I have computed, the n of minus d2 will directly come out as the probability of default. So wherever I'm looking at, so let's say in this example itself, I want to look out for d1 and d2, right? Probably the d1 in a regular case log the value of equity divided by, or the value of the firm divided by the value of the debt. Probably, so we are talking about the default that can happen at a future date. So divided by the value of the debt and plus, so because I am looking at a future date, I am using again the rate of return. So here I require, let's say, the rate of return on the firm, the expected rate of return on the firm. Let's say I take it as 10% plus sigma squared. let me take the sigma squared, let's say as 15% only, sigma squared by 2 into t, let's say 5 more years to maturity. So D1 is coming out to this much divided by sigma 15% into square root of t, 5 more years. So the D1 in this case is coming out to something like this, and probably the D2, right? And let me see if I have taken sigma squared by 2 into t, right? So probably let me take this as sigma squared by 2 into t divided by sigma root t. So it is working out to 2.51 log value of the firm divided by the value of the debt plus mu plus sigma squared by 2 into t divided by sigma root t. So it is working out to be the value of d1. So d2 is coming out as d1 minus sigma root t. So sigma is 15% into square root of t, which is 5 years. So d2 is coming out to be something like this. So from here I could have computed my n of d1 from the norm distribution equation. I could have computed my nd1 saying it is 99.4, and probably the nd2 on the same lines I'm taking it as 98.5. So n of minus d1, if I am looking at n of minus d1, what would be my n of minus d1? The same logic. So n of minus d1 will come to n of minus d1 will come out to 0.005, which is nothing but 1 minus nd1. So it is coming out to that particular number, and probably the same way n of d2. So this I call it as n of minus d1. The same way I can try finding out n of minus d2, which could be computed as 1 minus nd2, or probably the same logic. By symmetry I will get that 1 minus nd2. I could have taken it as minus d2, and I will get n of minus d2. So this is n of minus d2 is a measure of the probability of default. So in this case I can very easily compute that the probability of default for this case is 1.46%. That is the probability of default. And now when I have to compute the loss given default, my formula goes simply whatever is the face value of the debt, you multiply it with the probability of default, which is n of minus d2, and you find out the value of e power the return mu t, e power mu t, and you multiply it with n of minus d1. You multiply this with n of minus d1. The difference of this is going to give you the loss given default using the Merton model. So going with this same here. So the loss given default, the face value of the debt, which is 75, I multiply with the probability of default, and I subtract the value of the firm multiplied by e power mu, which is 10% into 5 years, e power mu t, multiplied by n of minus d1. N of minus d1 is going to be this. So the loss given default, I can very well say that it is 0.11 million. So 0.11 million is coming out to 117,000. Right? In case the loss, the probability of default is 1.46%. and in case a loss is going to occur, it is going to be 0.117. 0.117 is the loss that can occur in this case. So that is what is working out to be the computations for probability of default as well as the loss given default. Now we can easily make out, let's say if the volatility is increasing, right, the value of the option is going to increase, right? If the volatility is increasing, the value of the option is increasing. So n of minus d1 as well as n of minus d2, both of them are going to increase. So similarly, if the rate of return mu is increasing, what you see is the value of the option will increase, but at the same time, what you could see is the loss given default P of ND2 will minus ND2 will decrease, and the loss given default also will decrease. We can simply substitute the values into this equation to try out what could be the relationships associated with each of these variables, right? So this is how we compute the probability of default and loss given default associated with the Merton model directly. But of course, here we require the volatility of the firm as well as the value of the firm. So these kind of things, though in real practice they are difficult to arrive at, but we definitely require these numbers to finally arrive at the value of the credit risk, which can be computed using the probability of default as well as the loss given default, right? Now we will look out for credit portfolio models. Now that for individual bond we have used the Merton model, I will try to look out for credit risk portfolio models. Means more than one obligors. So we are talking about various credit risk portfolio models wherein my intention is to compute the credit value at risk for the portfolio. Sometimes we call it as CVAR or sometimes we call it as default VAR. Whatever are the terms that are being used, it is more associated with the credit value at risk itself. So it is primarily, again the definition goes the same way, it's the maximum loss at a given level of confidence, given confidence level for a given time period. What is the maximum loss that can come on the credit over a given time period for a given level of confidence? Now, the advantage with the majority of the credit risk portfolio models is they are not just targeted with one single debt as was considered as for the Merton model. They consider wide variety of debt and obligor instruments. So they look at subordinated debt, senior debts, equity. There are wide variety of debts that can come into the process, and at the same time they are also able to include some kind of derivative instruments like swaps also. So that way they are a better extensions to the typical Merton based models. So some of the common names that we will try to look out with respect to the credit risk portfolio models, there is one called credit risk plus. We have credit metrics, and we also have credit portfolio view models from KMV. So like this, we have various credit portfolio based mechanisms to compute the credit risk involved in a portfolio. So if I have to understand, probably the calculations wise, we may not get into quite in depth, but just as an understanding perspective also, okay, when I talk about credit risk plus, it is typically looking at each obliger. I take the list of all the obligers, means all the borrowers, and against each obliger I try to look at some common risk factors. So I try to look at common risk factors, how sensitive is each obliger is sensitive to the list of various common risk factors. Now we see that each obliger will have a different level of sensitivity to each of these factors, and so from here I try to compute the probability of default for each obliger. The probability of default for each obliger, I am trying to go based on the credit rating associated with each one of them, along with what is the sensitivity that each one is having with respect to the common risk factors. So these are the two inputs that are going in to decide the probability of default. And in general, when I am talking about all these risk factors, they have positive values. Whatever the risk factors I am considering, in general, they have positive values and they are scaled so that the sum or the average, they are scaled so that the mean is equal to 1. So for any particular obliger, if he is having a factor, for a particular factor, let's say the sensitivity is more than 1. So the probability of default, so probability of default for the firm increases in proportion to that of the obliger's exposure. The higher the exposure of that particular exposure of obliger, we see that the probability of default also will increase. So that is how the credit risk of the entire portfolio is assessed using this credit risk plus kind of a model. But on the other side, when I look at credit metrics, another tool that is typically used to measure the credit VAR. So all it says is you first start off with the credit rating associated with the debt claim, with the issue. Get the rating associated with the debt claim. Now take the rating transition matrix for 1 year. Take the rating transition matrix. So probably if the credit rating associated with this debt claim is AA, take the rating transition matrix, okay, from AA to AAA. What is the probability? AA to AA only, AA to A, AA to triple B. Like this, you continue, find out the probabilities, AA to C and probably AA to default. So you get the probabilities of the transition or migration from the current rating to a next rating within the next 1 year period. So based on that, compute the expected. So you estimate the distribution of the value. So you are trying to compute the expected values for the 1 year. and based on that you try to use the 1-year forward zero coupon rates, 1-year forward zero spot rates to get the current price of the bond. And so probably so for each rating you try to compute the value of the bond. So if it is AAA rating, what could be the value of the bond? If it is AA rating, what could be the value of the bond? And finally try computing the expected value of the bond using a multiplier kind of a mechanism, using a weighted average. Okay, what is the probability that it will reach AAA? And if it reaches AAA, what is going to be the value of the bond? Like that you add up all these things and finally say that this is the expected value of the bond. So based on expected value and the current bond price, you can very well compute what is the 1% VAR or 5% VAR associated with this particular bond. We can take one numerical slightly later to try to address this situation where but conceptually what we need to be clear is this is a mechanism where I start with the current debt level or current rating level associated with the bond, and I would try to find out the present value of the bond for each of the rating classes using the 1-year forward rates and the coupon rates associated with this current bond. And based on that I would also try to find out the transition probabilities, and based on the transition probabilities and the recovery rates I would try to find out what should be the expected value of this bond, and using the current price and expected value of the bond I would try to find out what is the credit VAR associated with this particular portfolio. So this is how I am using the credit risk mechanism to find out the portfolio value at risk. Now similarly, the one more aspect that I can look at is the credit portfolio view, where the focus is getting up with the transition matrices using macroeconomic or macroeconomic data itself. So probably try collecting the values relating to the GDP growth or interest rates. Try forecasting these various macroeconomic variables over a period using their respective cycles kind of an approach. So we are probably a particular industry growth rate. Various macroeconomic factors are being considered, and they are getting projected using a time series kind of mechanisms, autoregressive kind of mechanisms to project these various macroeconomic factors, and based on that we are estimating a default rate purely based on the index. Means it could, what could happen is if the index is high, probably the default rates are much lesser and vice versa. So depending on how the economy is at a particular point in time, we are trying to say whether the credit VAR would be higher or lower. So there is some kind of simulation that is getting performed based on the historical values, and there is a comparison between a simulated value and the historical values, and that simulation is actually helping us in deciding the credit value at risk. So with these various models using the various mechanisms to estimate your credit VAR, though they are successful in various dimensions to estimate the probability of default, there is a lot of challenge with respect to how they incorporate the dynamically changing interest rates, how they incorporate the credit spreads, and how they incorporate the current economic conditions. All these things will become a great difficulty while using the credit portfolio models for estimating the credit risk or for computing the credit risk associated with a portfolio, right? So now let's spend some time in terms of understanding the credit derivatives. So we have already defined earlier that a credit derivative is nothing but it's a derivative contract whose payoffs are based on some credit event, some credit default. The payoffs are purely based on some credit events like your bankruptcy. So the actual payment between the parties can happen only when either a bankruptcy comes up or failure or inability to pay, or we are talking of restructuring of the debt, right? Any of these. So the obliger defaulting either on the principal or on the interest. So the obligation is getting accelerated. All these are various elements of the credit events. So any of these credit events occurring, the payoffs of the underlying derivatives come into picture. Generally, they are used any of the credit derivatives. The most common one we all know that it is a credit default swap. But generally, any of these credit derivative instruments, they are OTC based instruments, and they are used generally as hedging instruments for various credit risks. So any of this credit event occurs, we talk about some kind of payment happening from one party to the other. A simple example, let's say we are talking about credit default put. So if at all there is a default, so whatever is the loss in the loan amount because of the default, that would be paid. So it's a simple credit default put. So as long as there is no default, nothing would be paid. But whatever is the default, based on the default, whatever is the loss that is going to occur, that would be compensated. Like that, we have different forms of credit derivatives operating in the market. We have already discussed something about the credit default swap, right? So we will look at a few of these terms now. So when we are talking about the credit default swap, when we are talking about a credit default swap, it's just like any other swap. Okay, one party is making a payment to the other party. So probably let me call this as CDS buyer, and this I call it as CDS seller. So the buyer of this credit default swap is actually buying protection against a borrower default, right? That is what is the typical way the credit default swap is working. So he is making a fixed premium payment to the CDS seller to give that protection. So it's just like an insurance contract. I'm doing a regular premium payment, and in case a loss occurs at any point in time in future, there would be a compensation for that. So the same logic will happen. The payments are happening to the CDS seller in the form of premium for the entire life of a swap. It could be for entire life of a swap, or it could be until a credit event occurs. Right? It could be looked at as either of them. So where here it's not the same as your interest rate swap or a currency swap where some notional amount and based on that the fixed and floating interest rates are exchanged. Here we are talking about the default on some payment. So if the credit event occurs, then only the buyer is getting a final settlement. So it could be, the settlement could be either cash based settlement or the physical delivery of the reference obligation. The bond is surrendered and corresponding to the bond the payment is received from the credit CDS seller. So the buyer, in that case, if we are talking about a physical delivery, the buyer is giving the underlying bonds to the seller, to the CDS seller, and receives the par value. But in case we are talking about a cash delivery, then we are talking about whatever the balance, whatever is the amount that is left, that much is being settled. Without whatever is the loss that got incurred, that would be settled after the recovery amount and all that. Whatever the loss that got left out, that would be settled in the process. The same logic when you say total rate of return swaps, just like a credit default swap, I can talk about total return swaps or total rate of return swaps. So it is primarily again an agreement. So where the reference asset, which is a bond, is taken, exchanging a total return of a bond for whatever the floating rate LIBOR plus a spread. So the bond is exchanged using this kind of a mechanism. So there is a capital gain or loss along with some kind of coupons that are involved in the process. So it is similar to that of an instrument, the underlying security in exchange for LIBOR plus spread. Right? If we are virtually looking at it, one side is an investment in the underlying security, and on the other side we are talking about LIBOR plus a spread. So from a payer perspective, if he is having the return asset, the reference asset, so it is primarily like the owner is transferring the credit risk to the receiver. But if the reference asset is not there, it's as good as taking a short position in the bond. So the value of the bond decreasing, the position of the payer is increasing, otherwise it is decreasing. So there are various such kind of credit derivative instruments that are floating in the market. So understanding a base about the various credit derivative instruments will really help us in understanding how they can be used to mitigate our underlying credit risk also comes into picture.